All right. Well, before I get started, I want to say thank you to a few people. Jeff Eckhoff in the City Planning Office and the Minnehaha and Lincoln County Equalization Offices. We could not do this without you. Thank you for your help in getting us this intel. To our team, Summer Hoffman, big one this year, 25 years. And also Elizabeth Edwards and Sarah Wolfswinkel, thank you, thank you, thank you. We could not do this without you. All right, let's get started. Know that our team does a huge deep dive every year into this, and we do it for you, the business community. Our goal every year is to provide you good, sound advice so you can make quality decisions, informed decisions, advised decisions as we go throughout the year, both you and those that you advise. Know that everything you hear today over the next 85 minutes could all be upended with some of the geopolitical tension we're seeing right now. If China invades Taiwan this year, everything changes. We've got ongoing conflict in the Middle East with Israel and Palestine. We've got ongoing war with Russia and Ukraine. Anybody hear that we've got a 2024 presidential election this year? We've got one grumpy old guy with questionable accounting against another grumpy old guy with a questionable memory. Buckle up, it's gonna be a wild ride, but we're all gonna get to see some must-see TV a little later on this year. Interest rates. A lot of discussion around interest rates. 2 years ago, the Fed started raising rates. Now all the questions are, when will they come down? How much will they come down? How's it gonna impact me? And we'll break that down here in just a few slides. As you look throughout the slide deck today, I want you to notice something. A national reset occurred, a reversion to the mean in 2023. Can the Fed deliver a soft? Let's find out. It all starts with jobs. During COVID, from February of 2020 to April of 2020, the United States lost over 20 million jobs. By August of that year, 11 million had come back. By the end of 2022, we'd reached full pre-pandemic employment. In the year 2023, we add an additional 2.8 million jobs. Historically, in election years, that softens a little bit. I'm going to predict that the US economy will probably land around 2 million jobs this year. Let's take a look at unemployment. We finished the year at 3.6% unemployment in the United States. It's an incredibly tight labor market still. In contrast, it's even tighter in Sioux Falls at 1.8%. Anybody who wants a job in Sioux Falls has one. Some maybe even have two. Take a look at CPI, Consumer Price Index. The Fed started raising those rates, and by the end of December of 2023, had inflation finally been tamed? We got a reading at 3.4%. It started to feel like it. But just last week, we got a white-hot 3.9% inflationary number. Now, I put the PPI index on here this year. What's the PPI, the Producer's Price Index? Think manufacturing, think construction, think creating a widget or a good before it goes into the economy. It's generally a leading indicator, and hopefully some downward pressure is forthcoming on the CPI. All right, this chart is the probability of the Fed funds rate, Chicago Mercantile Exchange. We looked at, the Fed meets 7 more times this year. We looked at the quarterly meetings. How much are rates going to come down? That 3.9% CPI number we saw last week all but eliminated any chance of a rate cut in March. But by June, there's a 75% chance of a rate cut. By September, there's an 81% chance of an additional rate cut. And by December, there's another 81% chance of a third rate cut. In that December number, there's a 50% chance, it's 50-50 whether we get that fourth rate cut. I'll save my prediction for the end. Let's take a look at bank deposits. Nick, in just a few minutes, is going to touch on the M2 money supply. The federal government printed over $6 trillion post-COVID. In the years 2020 and 2021, nearly $5 trillion of that found its way into a bank deposit account. In the last 2 years, over $2 trillion has been sucked back out, and that number is continuing to rise as people chase some additional yield. What is going to happen? Credit is going to get tight. New term this year for us, financial engineering. How are we going to get deals done? We're going to have to find a way to be creative. We've had clients that are doing swap notes and hedge notes, contract for deeds. We didn't even talk about those for a decade. In the last 2 years, it's a very real part of discussions with sellers and buyers and trying to come together. Sellers are also, if they want their number, they're willing to potentially participate in the seller carryback as well in a secondary position. We're starting to see some cracks in the economy. Nick is going to touch on the CMBS default rate. With CMBS, think big markets, big loans. But locally, we're starting to see some deed in lieu of foreclosures. I would look for additional foreclosure activity. I bet the credit guys in the audience are busier than they've been in the last several years. Assumable debt. A couple of the local lenders have even worked with our clients on assuming those favorable loan terms that were in place. Is that going to become the norm? I don't think so, but the bankers are certainly going to get asked the question. As we started looking at numbers, one of the trends we saw this year was the Gen Z squeeze. It doesn't feel very good to be in your 20s right now. Play this out with me. You're 28 years old. You've gone to college, maybe grad school. You're married, you have 2 kids. Your daycare costs are $12,000 per kid. Your cost of living has skyrocketed over the last 5 years. You haven't made a payment on your student loans for the last couple of years. Now you're making those payments. And now you've got a housing decision to make. There's never been a bigger discrepancy between the cost of home ownership and the cost of renting. What you see here assumes a median home in the country today, $400,000 with a 10% down payment on a 30-year AM schedule. That does not factor in taxes and insurance, but it does factor in PMI. It's over $3,000. After you factor in that escrow payment, you're between $3,000 and $4,000. That hurts. They're definitely feeling the squeeze right now, as opposed to renting for around $1,900 to $2,000 for an average apartment. Watch this trend. The kids in their 20s are definitely feeling it right now. Well, speaking of housing, let's take a look at Sioux Falls. What happened in the residential market last year? Residential is on the front lines of any economy. In 2022, 6,300 notes were originated. And that's new purchases, home equity lines of credit, refinances for $1.5 billion in 2022. Contrast that to 2023, 35% pullback. The residential market is also feeling the pinch. Last year, we introduced this slide. It's projects over $20 million. Now, Sioux Falls is growing up. We've gone from a big town to a small city. Last year, we predicted we get to double digits. Not quite. We had 8 projects over 20 million last year. I would look for this trend to continue. Over the next 3 to 4 years, 8 to 12 projects over 20 million. Sioux Falls is very investable. Let's take a look at commercial construction. Now, generally, in an expanding economy, new construction outpaces addition and remodel. What happened in 23? There was a 3-to-1 ratio. New construction was very strong last year. A couple of those projects are listed on the right. One of those I just will highlight is the Dillard's project. They pump faked the city for years. They finally pulled that permit. I believe they're actually opening here in just a few weeks. That's a big win for our city. How do we compare regionally? For the first time in several years, there was no real outliers on this chart. Sioux Falls finished with just over $1.1 billion in construction, roughly 5,000 per capita. But all these other cities in the upper plains here finished roughly the same. One outlier was Lincoln, Nebraska, a little softer in Lincoln. I do predict that Sioux Falls will be back on the top of the charts next year with some announcements coming in 2024. We started with jobs. We're going to look at some of the local job market now. Jobs start with people. Roughly 5,600 people moved into the Sioux Falls proper last year. We are just about to 214,000 people now. Our job market grew by about 3%. All you business owners, you continue to invest in yourself, your company, your employees. As long as you continue to grow and as long as you continue to hire, it's going to feel like an expanding economy in Sioux Falls. One more slide we had to add this year. it comes up in almost every single discussion, operating expenses. Over the last 5 years, your property taxes in Minnehaha and Lincoln County, the assessed value has gone up between 50 and 65%. Property owners are feeling the pain. Now, I'm not here to throw rocks at the equalization offices. They had a lot of reasons to raise those. They were stagnant for years, and we had a run up in value. But the property owners are also feeling it on the insurance side right now. The insurance market is incredibly hard. About 80 to 90% of that 45% was in the last 2 years. And there's no end there. It's going to continue to be a hard insurance market for the next 12 to 24 months. So they're going to continue to feel the pinch. Something to watch. All right, some predictions here. There's some choppy waters across the country, but the underlying fundamentals of Sioux Falls feel really good. We have a modest tailwind. You will hear some announcements in 2024, both in the suburban market and downtown. Recently, I heard the mayor say that thought the building permits would be around 1 billion, maybe 1.1. I'm about 20% more bullish than the mayor. It's going to be a good year in Sioux Falls. The 10-year Treasury, wild ride last year, down to 3.25 all the way up to 5%. Naturally, if the Fed cuts their rates, the 10-year Treasury should follow suit. However, I think the underlying inflation is going to be kind of stubborn and sticky. And the underlying economy also feels pretty good. So because of that, I think the 10-year Treasury is going to hold pretty firm between 3.75 and 4%. And the Fed funds, and one more note, I think this is the year on the 10-year Treasury where we start to see some of the unwinding of the inversion we've seen with the short-term treasuries. Fed funds rate. I'm predicting we will see 2 rate cuts this year because of the underlying economy across the country still feels pretty good, and the inflation numbers are going to be sticky. That concludes my presentation. I'd now like to bring up Nick Gustafson to present on capital markets. Platinum member, Swifty.
Thanks, Reggie. In this portion of our presentation, we focus on capital markets. Now, as investors ourselves, we know our clients have many options when it comes to allocating capital. Our clients can buy stocks, they can buy bonds, they can buy cryptocurrencies, they can buy commodities, they can even buy world-class wine. I think we're all relieved to know that the latest vintage of Domaine de la Remontie Conti is down 29% over the previous vintage for a mere $29,000 a bottle. It's a bargain. Why do we care about real estate to begin with? Why do we have all these slides? Well, when we take a look at the world's global wealth and we take a look at the total value of all the stock markets, all the bond markets, global GDP, all the gold that's ever been mined in humanity's history, real estate is greater than all those asset classes combined. In a short way of putting it, real estate is a great storehold of the world's wealth. We're going to take a look at 6 major factors that are impacting capital markets, and then we're going to take a look at 5 results, and then we're going to take a look at some specific examples. The very first thing we're going to take a look at is the M2 money supply. What is the M2 money supply? Well, it's simply a measurement of cash in the US economy. That's cash in your wallet, that's cash in your checking account, savings account, money market. That's just cash, okay? This graph goes all the way back to 1959, and you can see during the COVID era, that's that gray bar to the far right, we as a nation made a decision to support individuals, businesses, and local governments with a lot of stimulus. We printed a lot of money, and we expanded the M2 money supply by nearly 40%. So keep this in mind. Let's go to the next slide. Our next major factor is inflation. Well, in Economics 101, you learn that when you dramatically increase demand, or the capital available, and you don't do anything about supply, prices rise. And prices did rise quite a bit. This goes back to 2013. These are annualized inflation numbers, and you can really see when the M2 money supply expanded, 21, 22, 23, big inflation numbers. Keep this in mind too. Let's look at our next major factor. 10-year treasury. Now, this is usually a factor in all major commercial real estate decisions because this 10-year government bond is usually considered the safest investment on the planet, okay? It was volatile, as Reggie mentioned in his presentation. It went from basically 3% to 5%, but the 10-year treasury is not calling the shots right now. Typically, bankers take a look at this and they base their loans, their interest rates off of this, but that's not the case this year. Right now, bankers are really eyeing the Fed funds rate. What is the Fed funds rate? That's the rate at which banks borrow from the Fed. And as deposits are leaving those traditional checking and savings accounts and going into money markets, which we'll take a look at in just a bit, the Fed's fund rates, when a borrower goes into the bank has to often borrow money in order to make the loan. And the bank needs to have about 250, 300 basis points to have profit and some margin of safety. And so investors right now, when they go to sit down and buy an investment property, their banks are telling them often 7.75% to 8% interest rates. We're going to test fit that on a specific investment property in just a moment. Money market funds. You heard Reggie mention money markets. I'm mentioning money markets. And after the COVID era, money market funds increased about 50%. That's not the big takeaway. The big takeaway is that because of that Fed funds rate going up, investors are getting between 4.5% and 5% just hanging out in a money market with almost no risk. So if you have your life savings in a money market right now yielding 5%, you're feeling pretty good about that. Let's take a look at the dry powder. What's dry powder? Well, this graph shows the amount of capital that's sitting on the sidelines that has committed to a real estate fund or a specific real estate investment but has not yet been deployed. So there's essentially $250 billion sitting on the sidelines right now, ready to invest in a real estate transaction. So there's a record amount of dry capital on the sidelines right now. So keep in mind, a ton of money, a record amount of money in money markets, a bunch of money in dry powder. Let's take a look at what happened last year in terms of investment transactions in terms of dollars in the United States. This goes all the way back to 2007. And direct your attention to the far right of the graph. We were down nearly 50% nationwide in commercial real estate transactions. That's a big drop. Let's take it a step further. Let's compare it to Sioux Falls. Now, in Sioux Falls, we've all lived here. We love living here. We always say to ourselves and to our friends, Sioux Falls is different. We're small, we're vibrant, we're growing. It doesn't matter what's happening in the rest of the country or the world. Well, this time it's a little bit different. We are having the same math problem that the rest of the country is having. Between 22 and 23, Sioux Falls multifamily was down 40% in terms of transactions. Sioux Falls office 37, industrial 42, retail was down 66%. Now, it's really clear for me, I want to make a point and be really clear about it. This is not a crisis. This is not a crisis. This is a math problem. We have a ton of cash just sitting on the sidelines. Interest rates are very high right now. That's what's slowing down these transactions. Not all asset classes are navigating this new environment the same. Andy Anderson's going to talk a lot about office in her presentation. Now, office in a really large office building in downtown Chicago, Minneapolis, they're not doing good. People stop showing up to work there, and they may not be coming back anytime soon. Values are down about 40%. Office around the country, these are national numbers, please keep in mind. National numbers for office, suburban's down 20%, apartments are down about 15%, retail's doing okay, hotel and industrial seem to be retaining their values well. We're not going to spend a lot of time on commercial mortgage-backed securities this year, but they're basically a sliver of the debt market that's publicly traded. So we can see at any given moment what the health is in the commercial mortgage-backed securities market. Typically, there's a really big loans that are traded on Wall Street, they're packaged up, investors buy them. But let's take a look at the special servicing rates. All right, what's a servicing rate? Well, that's a rate that happens when a borrower misses one or more payments on their CMBS loan. It's not a foreclosure, but that loan has become distressed or troubled for some reason. If we take a quick look at the bottom of the graph, industrial, no problem. Multifamily, no problems. The big takeaway here is office is suddenly showing signs of distress. Office is about 3% at the beginning of the year, and it's going all the way up to about 10%. There's a lot of weakness in that office CMBS market. Let's talk a little bit about cap rates. This is a national cap rate slide that goes all the way back about a quarter century. And what we've noticed over the last 12 to 18 months is cap rates are up about 200 basis points across the country, across asset classes. Well, we've looked at a lot of slides, we're looking at a lot of percentages. Let's make it real. Let's take a look at a very simple investment, and let's take these new cost of debt, these new interest rates out for a spin. I specifically did not want to choose a Sioux Falls property and hurt anyone's feelings out in the audience. So we took a Starbucks that's brand new in my hometown of St. Charles, Missouri. That's where I was born. And this is a brand new Starbucks. It was built in 2023. It's on the open market for about $2.9 million. It has a 12-year lease, and it's listed at a 5.75% cap rate, which is pretty close to what Starbucks sold all over the country last year. So let's take a test fit on interest rates. I walk into my bank, I say, hey, I'd like to buy this Starbucks. I want to have something that makes me feel close to my hometown. My friendly banker tells me, hey, no problem, we can do that for you. Let's do a 7.75% interest rate with a 25-year amortization. Okay, great. Going to do 25% down, which is about $700,000 worth of equity. And because of that interest rate, I'm going to have a negative $30,000 a year cash flow on that property. That's a negative 4% cash on cash. Okay, that doesn't feel very good. What if I put some more money down? If I put 36% down on this investment, that's about $1 million, and that's going to essentially cash flow at zero. Okay, that doesn't feel good. How much money do I have to put down on this investment to equal what I'm getting in my money market? The answer is 85%. If I put 85% down, I'm going to get a 5.17% cash on cash return. I don't feel very good about that. I'm just going to keep my money in my money market. And that's exactly a lot of the calculus that's happening. That's why there's been a 50% drop in investment transactions. Okay, we've done the math. We took a look at a specific example. Now what? Sellers are going to be motivated by profit taking. Some of these graphs look really scary, but the reality is that over the last 5 to 10 years, there's a lot of investment properties that have seen tremendous appreciation, sometimes 200-300%. Some of these owners are going to think about taking profits off the table this year, especially if there's a pending refinancing event. Okay, if you learn that you're going to have your term of your loan's coming up and suddenly you have to borrow really expensive debt to refinance, you're going to be like, well, maybe it's time to sell this year. All right. Also, sellers might sell because they want to fix a problem. All right. As the economy weakens, maybe there's a problem in a core business. Maybe there's a problem on another property. All right. Or maybe there's a weakness by the tenant. Those are all things that are going to motivate someone to sell a property that they've been holding for some period of time. What's motivating buyers? Creative financing. Reggie really nailed it on this. Carrybacks, short-term contract for deeds, any sort of creative incentive that a seller can give a buyer right now is going to matter a lot. 1031 exchanges are always motivating. And of course, buyers will continue to gamble on future appreciation. All right, we're going to go through a couple of local Sioux Falls examples that sold in 2023, and we're going to take a look at these cap rates. Now, I realize some of you have been underwriting these cap rates, these investment properties for 10, 20, 30, 40 years, but there might be some of you out there that don't understand what we mean when we say cap rates. Very simply, a cap rate or a capitalization rate is the annual return an investor would get from buying a property if they paid cash. So it's a really simple apples to apples. Let's go through a couple of these. Eastside Strip Mall, 7.32% cap rate. Next door, different buyer, different seller, 8.34% cap rate. Starbucks Pancheros, 41st Street, sold for a 6.19% cap rate. First Bank and Trust, we know where that's at downtown, 6.9% cap rate. DGR Engineering sold this really nice office building on 57th Street to an investor that had a tenant in pocket, 8.36% cap rate. Aerotech office building, 8.4% cap rate. Multi-tenant office building on South Kiwanis Avenue, 8.58% cap rate. And an industrial building that was a short-term sale leaseback at an 8.11% cap rate. Some predictions. I hate to break it to you. I hate to break it to myself, but I have a strong feeling that the Fed is going to keep rates higher and longer than we want. We had a really hot inflation reading, as Reggie mentioned, about a week ago. We are 1 or 2 hot inflation readings from having 0 rate cuts this year. All right? As a commercial real estate broker, I want rates to be 0, right? I want money to be free. I want everyone to buy and sell. Unfortunately, I think inflation's going to be a little bit stubborn. Cap rates, excluding multifamily, Alex Saudi is going to focus on that, are going to be between 7 and 8.5%. I do think we're going to see a 15 to 20% increase in sales volumes in Sioux Falls next year, and that's simply because buyers and sellers are adapting to a new rate environment and they're adjusting their pricing expectations. With that, I'd like to bring up Braden, and he's going to talk about the land market.
All right, thank you, Nick. As Nick said, my name is Braden Nisus, and I'll be presenting on the land market. Before I get started, I do want to just give a big shout out to our mayor here, Mayor Paul, for his crucial leadership here in our community, and that is making it appropriate to wear comfortable shoes on a day like today. So thanks for that. Let's get started. I'll start talking about unimproved land sales, which is, by definition, large tracts of land purchased for the purposes of development. And as you can see in this graph, this represents the number of transactions that happen each year. And last year, we actually ticked up. We had about 15 total transactions throughout our Sioux Falls Metro. Where did these take place? And some pricing. A lot going on here, but I'll direct your eyes out to the right, top right, out in Brandon. We had 2 transactions in Brandon, $25,000 and $34,000 an acre. Down in the southeast, we had several transactions ranging from $30,000 to $48,000 per acre. I want to point out 2 of those sales were the city of Sioux Falls purchasing land for the South Veterans Project between Minnesota and Western. Over in T, we had 1 transaction, $62,500 an acre. That's a commercial development that'll be coming online. And lastly, up in the northwest, we had 2 transactions, $40,000 per acre there. A few more sales. We really gave these its own category. I term them infill sales. They're somewhere in between unimproved and improved, and depending on where they are in that spectrum, you can kind of see the pricing there. Let's look at some more data. In this graph, it represents the number of acres that were purchased each year. And you can see we're kind of coming back down to what I think is going to be the new normal going forward. We came in about 950 acres last year. But looking through the data, something kind of caught my eye and something I wanted to explore and share with you today. And that is the percentages of acres that were purchased in our Sioux Falls growth area versus our neighboring communities. Now, we went back the last 6 years, and Sioux Falls growth area consumed about 80% of those acres each year or more. Last year, that ticked down to about 65%. And if you take those 2 sales out that were for the South Veterans Project, that actually goes below 60%, about to 59%. So what's happening? What's going on? Let's take a look. I want to introduce you to the Sioux Falls tier map. And this comes from the Sioux Falls website. And what this does, this helps the city of Sioux Falls communicate to developers on a timeline of when they're going to be able to provide the services needed to develop land. One of the services that takes the longest time, takes the most resources, is a backbone sewer line. Well, when was the last time the city invested in one? Well, that was in 2007, our East Side trunk line. For 17 years, that has fueled the development in our southern and eastern sides of Sioux Falls. So what's next? Well, we have tapped out going further south, so priority number one actually is out on our west side of Sioux Falls. Think Cherry Lake. That'll open up about 3,000 plus acres out there. But what about the development down south? That's priority number two. So we're still years away from getting online. So what's going to happen? Well, a few years ago I presented on Harrisburg making a big investment in adding a trunk line out to their new elementary school out by the Baker Crossing Golf Course. I believe in 2024 they're really going to start seeing a return on their investment there. And because of that, we'll see more acres purchased in our neighboring communities than in our Sioux Falls growth area. That percentage is going to flip, I believe, in next year. And that's going to put more pressure on the city to maybe look at that south side and bring that timeline up a little sooner for that south development. Let's move on to improve. As defined, take the large tracts of land, add the infrastructure, break them down into smaller lots, and sell them on a per square foot basis. Let's take a look at our data. As you can see, the number of transactions actually came down a little bit. We ended with about 75 total transactions, but our overall sales volume actually grew. We had about 95.7 million. Let's break these down to the different assets. In office, we ticked up a little bit. We had about 8 total transactions, which to me shows a little bit of signs of health in our office market, particularly the smaller office lots, maybe for somebody that's going to build their own office. Multifamily, we continue to see a downward trend. We had 6 transactions last year. Retail continues to be the steady performer. We had 35 total transactions last year, and really anchored by the number of C-stores that are expanding throughout our market. And lastly, industrial. Industrial had 26 transactions, and it's actually a 4-year low in industrial. Now, if you were with us last year, you would remember that I presented on my concern about the imbalance of supply and demand here in our market. So where are we at today? Now, just to remind you, this conversation really centers around lots that are less than 10 acres, as that is really the larger majority of what gets transacted. And the Development Foundation really is committed to keeping their parks for larger lots and not subdividing them and competing. So as you can see, in 2022 at this time, we had about 15 months of supply in our market. So where are we at? In 2023, our sales were down. We actually came in about half of the number of acres that were purchased. We had about 65 acres purchased. And we did a study recently. We had 175 acres of supply. So our supply actually grew a little bit, which resulted in about 32 months of supply, which feels a lot healthier to me. But what is healthy? What should we get to? Now, I'll be honest, I don't have the answer. I don't have a textbook that says this is where we need to be. But in my opinion, 36 months feels a lot better and something we could strive for. So there's still room for more supply in our markets, especially because I also believe that our demand is really being held back a little bit by our pricing. So let's take a look. On average last year, an industrial's 1 square foot of land was sold for $4.51 a square foot. Now that's a 9% increase from the previous year and almost a 40% increase in just 2 short years. Likewise, multifamily, almost a 30% increase over the last 2 years. Now, if we look back, the sales that were down, those 2 categories right there. In contrast, retail and office, pricing seems to be pretty stable, and those sales are up, which brings me to my predictions. As I said, I think 1,000 acres is going to kind of be our new normal going forward, and I believe we're going to come in at just about that next year. But again, I believe a majority of those will come from our neighboring communities. Retail and office, pricing is pretty stable. I think there's still health there, so I continue to see a healthy amount of sales in those 2 categories. Multifamily land, the Price is still up, and there's still several other challenges that Alex is going to talk about developing multifamily. So I think we're going to continue to go down. Industrial sales, I feel differently. I'm still a little bullish on industrial. I think our pricing is going to stabilize as more supply is going to be added, creating a little more competition. Look for Harrisburg to add some more industrial lots, and look for a new competitor in this market. Look for the community of Hartford to bring some more industrial to compete here. That concludes my presentation. With that, I'll bring up Andy Anderson to present on the office.
I did not get the comfy shoe memo, just for the record, so I'm sad that I didn't get that. But my name is Andy Anderson. I will be presenting on the office market, and I'd like to start off with some national trends that we've all been hearing on the national news lately, and that is just the amount of vacant office space that is out there right now. Now, the challenge with this is the majority of these buildings were built in the 80s and the 90s. Now, that's a concern because to retrofit or renovate these properties is going to be very expensive. So any owner of these buildings really needs to be very realistic about what they would consider selling them for to entice a buyer to take on some of these challenges. And with all this vacancy, it's no surprise. We're at an all-time high vacancy rate of 19.6%. Now, the other concern is a lot of this vacancy, they are coming due for refinancing over the next 18 to 24 months. Now, blending and extending these loans worked when interest rates were low, but now that interest rates are so high, that model just doesn't work anymore. So it'll be interesting to see how those conversations play out. And we've all seen a change in how employees operate over the last few years. We still have a hybrid type of model of 29% of people working part-time from home as well as at the office, and 13% still full-time from home. Now, this has really upended the office market. It affects the metro areas more than we've seen here at a local level. Those restaurants and retailers really need those bodies to support their businesses. We no longer have to live where we work. So employers are really trying to come up with some inventive ideas to entice employees back into that office space by creating a really homey environment and just get those bodies back. They really need that to create and develop that culture and keep it for their businesses. Now we're going to shift gears to the local market. We have a total of 9.3 million square feet, and 1.2 million is currently available for lease, resulting in a vacancy rate of 13%. In 2023, we had a total of 33 sales transactions, resulting in over $51 million in sales volume. Now take a look back at a few years. That gap was really wide. Now that was due to lower interest rates and buyers paying more for the properties per square foot. Now that interest rates are higher, that gap is really tightening. And we saw a range in sales, anywhere from $45 a square foot all the way up to $325 a square foot. What I found was interesting was 67% of those 33 sales were less than $200 a square foot. That's significantly lower than what reproduction would be. Now let's take a look at the first sector, the CBD, or the Central Business District. We have a total of 2.67 million square feet downtown, and we're currently sitting at an 8.2% vacancy rate. We have over 200,000 available for lease, and lease rates have remained consistent in the CBD, and I do think we're going to see some changes in rental rates, which I'll touch on in my predictions. Now let's shift to the suburban sector, which is everything excluding the downtown market. We have 6.65 million square feet, and the vacancy rate here is double what the CBD's is, sitting at 15%. This is a big number. We have over 900,000 square feet available for lease. And asking lease rates here have remained consistent, but again, I'll touch on this in my predictions. I think we're going to see some changes in those. Now let's just address the elephant in the room. I mentioned we have 1.2 million square feet vacant. 900,000 of that square feet sits in blocks of 10,000 square feet or more. Now, most of that square footage is owned by corporate entities looking to liquidate these properties. So over the next 12 to 24 months, we're going to see below market sales taking place. So I really hope we see public and private dollars come together and think outside the box for adaptive ways to reuse these properties. And my predictions, I think hybrid work model is here to stay. I don't think that's going anywhere. We may see a change in the percentage of people that choose to work that model, but I do think it's here to stay. And Reggie mentioned the taxes and insurance increasing significantly. That is going to seriously affect triple net expenses. So any tenant looking to lease space over the next 24 months is going to have to take those increased triple net expenses very seriously. And then what will happen is they'll have to be able to negotiate on that base rent. So I do think we're going to see base rents drop over the next couple of years. How significant? We'll just have to wait and see. And I think we're going to see some big announcements again downtown. That'll be very exciting for the Sioux Falls market. And with that, I'd like to bring up Rob Kurtenbach.
All right, thank you, Andy. Well, let's chat about some retail. We're going to do things a little differently this year. We're going to see how much you all know about what's going on in the retail market. So we're going to put a QR code on the screen. This is the same QR code that's in the flyer that you were handed when you came in. I'd ask that you get your phones out, open up your cameras, scan those QR codes. If you're having trouble getting the QR code working, you can also go to slido.com. There's a event code at the very top, and you can type in 2024 retail. So we're going to go through 4 questions. And before we get to the first one, I just want to preface it with we're going to start with a really, really simple question. Okay, let's put the first question up. Who is the greatest college football team? We must have forgot to reset our results because these guys were trying to mess with me. So Jackrabbit fans, get your phones out and start voting. So like I said, I want to start out with a really simple one. The 2-time national champion, SDSU Jackrabbits, better represent, or I'm going to have to figure out what I'm going to say here. All right, and I know the USD fans in the house are wondering, well, what does this have to do with retail? It's a great question. Well, every January, there's a substantial spike in blue retail product that is sold. That's all. That's all it's about. All right, let's continue on with some other retail-related items. Last year, we talked about shrinkflation. And before I forget, keep your phones out. We will have 3 more questions coming. But last year, we talked about shrinkflation. If you weren't here, think about shrinkflation as retailers shrinking the product that they're selling to us, but they're charging us the same price. So you got 2 less chips in your bag of chips because they were trying to cut their costs. Well, we're going to talk about that a little differently this year. There's another trend that's happening where retailers are shrinking their footprint on new buildings that they're leasing or purchasing. So we're going to look at 2 examples. And then we're gonna talk a little further about those. So the first one is Macy's. So if you know what Macy's is, it's a massive department store. Their average store size is over 200,000 square feet. It's massive. Shortly after COVID, they announced that they were closing 80 stores nationwide. Well, those stores have closed. Last fall, they announced that they're going to be opening 30 new stores starting in 2024 with a new, smaller concept. So let's look at our next question here. What percentage of a decrease in size will the new Macy's concepts be? So 75% decrease would be 50,000 square feet, 63% decrease would be 75,000 square feet, and so on. So I'll tell, as you guys are answering that and looking at these results, I'll tell you that Macy's is heavily invested in technology to figure out exactly who is buying what in each city and in each neighborhood. So they're tracking their foot traffic into the stores, they're tracking what you're buying online, they're tracking what we're doing on social media, and there's a bunch of other online analytics that they're gathering so that they know exactly who their customers are. And what helps them is that they can then take that data and utilize it to buy product that they believe you will use, shrink their building footprint size to only offer the products that they believe you will want. Well, the correct answer here, you guys were wrong. It is 75% decrease. Their new footprint size will be about 50,000 square feet. So it's a pretty dramatic change in size. All right, let's look at another example, Starbucks. We all know Starbucks, right? Starbucks, their average store size is about 2,000 square feet, give or take a little bit. A couple years ago, they started this concept called Starbucks Pickup, and in recent years, it's gained some momentum, so they're going to start launching more of these. So let's look at our next question. How many square feet will the new Starbucks Pickup locations be? 800 feet, 1,000 square feet, 1,200 square feet, or 1,400 square feet? So I'll tell you, in South Dakota and in Sioux Falls, we don't have any of these concepts here yet. The closest one to us is in the Minneapolis area. But I think we can all probably naturally think about scooters or the Caribou Coffee Cabin concept. Those are smaller footprints, but those are really drive-through oriented concepts. What Starbucks will be doing is really focusing on mobile ordering. So the correct answer, you're wrong again. We're gonna have to talk to you guys after this. 1,000 square feet is the new concepts for the Starbucks Pickup locations. Now, those sizes will vary a little bit depending on availability, but generally speaking, they're going for about 1,000 square feet. So what does this mean? Well, it's just another example. It's two examples of retailers shrinking their footprint and getting a little more creative with their new concepts. Let's go to the next slide. Well, are there other retailers doing the same thing? There is. They all are, or not all of them are, but a lot of them are. What you're looking at here is showing us what the average new lease retail square footage size is, dating back almost 20 years. And in 23, we hit the lowest that we've had since this was being tracked at 3,200 square feet. Retailers are shrinking their footprints. Well, what does that mean to us? Will that have any impact to us here in Sioux Falls? Maybe. I think a question that we really need to think about, or an interesting question to ask, is where will our next regional retail center be? So I have one more question, so don't put your phones out yet. So where will this next regional retail center be? When we think of regional retail center, think of Dolly Farms. That's over 300 acres of mostly retail, and it's virtually sold out. Think about Lake Lorraine on the west side. That's over 200 acres with some of the neighboring areas of all retail virtually sold out. You got the mall, the Menards, and Home Depot area. That's about 400 plus acres of retail. It's all sold out as well. So where will the next regional retail center be? Or have the days of those regional retail centers come and gone? Let's go to the next question. This is our final question, then you can put your phones away. So in Northwest, think of where Walmart is. 60th Street North, Marion Road, I-29, I-90, kind of up in that northern area. That's what we're saying when we say Northwest. There's definitely some land available up there that could happen. Southwest, that's 85th Street and I-29. If you know where Orthopedic Institute is building their new facility, that's where we're talking. There'll be an overpass there with access to the interstate in the coming years. South, there's a few different areas we could pick, but for the sake of the conversation today, we're going to say Louise Avenue and future South Veterans Parkway. So if you don't know exactly where South Veterans Parkway is going to be, think about getting off at the T exit, heading east, and you go to that sweet little roundabout. That's where I'm talking. Or last option, is it none of the above? Neighborhood retail centers are the future. Well, what do we got next here? Go to the next slide, please. All right. Well, let's talk about what does that mean for us here in Sioux Falls. Well, I want to talk about what the city is thinking. There is no correct answer here, but what we want to look at what the city is thinking. So what you're looking at is the 2040 future land use map. You can see these large red circles on the map. Those are those current and future regional retail centers. Dolly Farms on the east, you got downtown, you got the mall and Lake Lorraine area. The city is suggesting the northwest area that we talked about and the southwest area that we talked about are where those future regional retail centers are going to be. Well, I think we all know Sioux Falls does tend to skip to its own beat from time to time, and I think that's something we all take a little pride in. But national trends are suggesting that we're going to be going more to neighborhood retail centers. We talked about Macy's earlier. They're taking note. They're prepping for this with smaller footprints. All right. Time will tell on where that's going to go. So let's look at some retail vacancy rates. A few years back, we had several Shopkos and a Kmart and a few other large retail centers that had hit the market. It kind of messed with our vacancy rates there for a few years. We've really started to stabilize over the last 2 years here. 2023 coming in at 8.1%, pretty close to where we were for 2022. Let's look at retail property sales. This has not stabilized. As you can see here, I want to focus your attention on the black line there. That's the sales volume. Nick mentioned this earlier. We had a 66% decrease in retail property sales volumes from 22 to 23. However, I want to also remind you what Braden talked about is that the retail land sales have been very strong. And I will tell you the construction numbers for new retail product has been pretty strong as well. To me, this is more of a math problem, less of a retail problem. Let's talk about predictions. Shrinkflation's here to stay. Retailers are going to continue to get creative in ways to figure out how to keep their bottom lines healthy. Neighborhood retail centers, I really believe they're the future. I'm not here to say that Sioux Falls couldn't skip to its own beat again and figure out a way to do it, but I think those large land tracts in those areas are going to take a lot of time to get developed. I think neighborhood retail centers are the future, and as I mentioned before, the Macy's of the world have taken note, and they're already prepping for this. Vacancy rates, they're going to remain steady. We've kind of gotten through the volatile time, and I think we're going to see this remain pretty steady here in 2024 at around 8%. Property sales, I do think they're going to increase for 24. We had a pretty big drop from 22 to 23, so I think we can only go up, so to speak. But I also think that's going to play into the fact that buyers are starting to figure things out in this new interest rate climate, and sellers' expectations are beginning to get a little bit reset. So for those couple reasons, I think our property sales will be set to increase. Where are we at on the real estate cycle? There's a lot of things to consider when you try to figure out where we should be on this. I do believe we're still in expansion with all things considered, and it'll be interesting to see where this next year takes us. So with that, I'm going to invite Rob Fagnan to present on the industrial market.
Thanks there, Roku. Well, I was going to try to get some audience participation here like Rob just did, and I was going to have you guys all stand up and start doing jumping jacks to kind of keep the blood flowing here, and Nick was going to lead us in that, but we were worried about his biceps kind of busting through his suit there, so we chose not to do that. All right, so what's going on in the industrial world these days? Well, for many years, it's been known as the darling asset class. But if you're like many who follow a lot of the national media outlets, you might be thinking a little bit different. So, I wanted to highlight a few articles that popped up this past year. We had sales plummeting in 2023 from 2022. One report had indicated by roughly half. And we had a Wall Street Journal article talk about how the great American warehousing boom being over. Further detailing in that article that in 2023, new construction starts had dropped 70% since its peak in 2022. Then we had discussions of massive layoffs coming in 2024. And in the transportation industry, UPS announced 12,000 job cuts. Yellow Corp filed for bankruptcy, which resulted in 30,000 workers being laid off. So we got sales plummeting, new construction falling off a cliff, and massive layoffs. Now, I don't know about you, but this doesn't sound like much of a darling asset class to me. So, is there any positive news out there? Well, in fact, there is. Prologis, the largest owner of industrial real estate in the world, acquired $3 billion worth of warehouse this past year. So the question is, are we feeling Are we sensing? Are we starting to trend towards that extreme pullback that we're reading about on a national level? Or are we in acquisition mode like Prologis? So let's dig in. And when I talk about our industrial market, I always like to highlight some of the sub-sectors within the market. And much like on a national level, we track warehouse distribution, transportation, manufacturing, but a large part in our area that national does not track are contractor shops. Now, when I talk about our area, most people think of our area, local industrial market, being Sioux Falls proper. In fact, you can see here on the map, unlike a lot of the other sectors presented on today, the industrial market covers a much wider area around Sioux Falls. This past year, the market increased by 3.8% overall, up to about 31.5 million square feet. So, what drove some of that growth? Well, on the manufacturing side, McGuire Iron built 113,000 square feet for its new campus up on the north end of town along I-90. Dakota Digital expanded their existing facility. And Presidio Components, they're one of those success stories of an out-of-state company moving to town and really banking on Sioux Falls and South Dakota for their future growth. On the warehouse distribution side, Cave Gamers. This is a really neat story of a local USF guy who essentially started out of his garage and in a few short years built this company into a 64,000 square foot facility. JDS Industries, they added on to their facility, I believe this was their 4th addition to their corporate headquarters up on the north end of town. And then P&H Wholesale. They took a property up on North Kiwanis, raised the property to build their new warehouse. On the transportation side of things, NCI and Volvo moved off of what we like to refer to as Old Truckers Highway up on North Cliff to areas that are much more visible with better access. And so NCI is right up along I-90 and Volvo's going over to Benson and I-29. So these are just a few projects that took place this past year, but how is construction, new construction, doing overall? Well, for 2023, it came in at just below 1 million square feet. Now that big bar you see there, some of you may not remember, hopefully you do, that was Amazon. So 2023 was really another strong year of new construction. And so what's fueling this construction? Well, simply put, absorption. As fast as we're building product, it's getting absorbed within this market to the tune of about 800,000 square feet in 2023. So we got high new construction, high absorption. It's no wonder why we continue to see low vacancy rates, sitting at about 3%. And I know we're seeing a bit of an uptick in that rate, but it's still very low historically. And you can see we still have our historic run of being well below the national average, which was 4.6% in 2023. So again, high new construction, high absorption, low vacancy. I would expect sales, generally speaking, to start tapering off because if sales aren't happening, it's forcing people to go build new. But that wasn't the case in 2022 or 2023. We continued this upward trend, 56 total transactions in 2023. Now, we did see a bit of a drop from $114 million being spent down to about $68 million, but I chalk that up to just the deals that got done this past year were much smaller in size than what we saw back in 2022. Okay, I wanted to take a snapshot this year and just look at those sales on a price per square foot. Now, you can see 63% of all the transactions that occurred this past year were between $76 and $125 a square foot. If we rewind back 10, 15 years ago, about 90% of the industrial sales would have been under that $75 a square foot column. You heard Reggie, you heard Nick talk about inflation. Obviously, that's one of the main reasons, the inflationary cost of construction these past couple of years, as to why it's driving up these sales numbers. And then there's obviously a few outliers there. Okay, let's switch gears and take a look at the leasing market. And the shaded area up there, it might be a little tough for some of you to see in the back, but the shaded area is simply a range of asking lease rates within each class of industrial. The line graph represents the upper end of those rates. And you can see rates have consistently been moving upward over the past several years. And I'll talk about in a second here where I think that's headed for 2024. Okay, on to my predictions. New construction's going to remain strong, especially with some of the pending projects that are already underway and about to come about. Braden talked about how strong, even though there was some tapering off, how strong the industrial land market was this past year. So new construction is going to remain strong. Vacancy. I think vacancy will taper off and more than likely drop this year as the market absorbs about 270,000 square feet of existing space in 2 spec projects, the Docks and Alloy 1 here in town by year end. Lease rates and the price per square foot that people are paying. Like I said, we've just seen this rampant increase in pricing across the board, both on a price per square foot standpoint and lease rates. And so I think 2024 is going to be the year of stabilization where it starts to plateau off. And as for sales transactions, I do think we'll finally see a tapering of transactions. There's just so few properties on the industrial side that are coming to the market. If we look at the real estate cycle, it's interesting because we could go back and pull up so many years from before, but we continue to be in this perpetual stage of expansion. So for 2024, the sellers and the landlords in the room and out in the market are going to remain in the driver's seat. So with that, I would like to bring up Alex to show everybody how to moonwalk on stage.
Well, thanks, Rob. No matter how much I prepared for today, I knew the one thing I couldn't prepare for is how Rob was going to introduce me on stage. So glad that's over with. So as Rob said, my name is Alex Soundy, and I'll be speaking on the multifamily market today. Let's get into it. Let's start by taking a look at the national market, starting with national multifamily sales. Now, 2021 was a historic year for the national multifamily sales market. We saw just over $350 billion worth of total sales volume. Now, 2022 was a strong year as well, with right around $300 billion. 2023, we saw a 60% reduction, down to $117.5 billion, which brought us to the pace we were at back on 2014. Now, for those lenders and investors in the room that remember the fourth quarter of 2021 and how busy that was, there was more multifamily sales in the fourth quarter of 21 than there was in the entire 2023. Think about that. So why was that? This graph you're looking at here shows the multifamily cap rate spread dating back to 2001. Now, for those that don't know what a cap rate spread is, the cap rate spread is the difference between a market cap rate and the 10-year treasury rate. So for example, if a multifamily asset trades at a 6% cap rate and the 10-year treasury is at 3.5%, the cap rate spread is 2.5% or 250 basis points. So why is this an important metric for us to track when looking at multifamily sales? Well, think of the 10-year treasury as a risk-free asset. whereas commercial real estate, in this case multifamily, bears some risk of vacancy, risk of property damage, or risk of market conditions. So that cap rate spread is essentially that risk premium that an investor is getting for investing in that asset. So going back to 2001, the average cap rate spread for multifamily assets was right around 310 basis points. Now, the last 18 months, we've seen that cap rate spread tighten. The third quarter of 2023, that cap rate spread was at 116 basis points. Now, that's the exact reason we've seen a pullback in multifamily sales. Investors are keeping their capital on the sidelines and saying, I'm going to take a high risk-free return instead of taking on the risk of investing in that commercial real estate. So, moving forward, if we're going to see sales volumes increase, we're going to see one of two things. We're going to see cap rates go up or interest rates go down. Now, another reason we've seen a little bit of a pullback in multifamily sales is what we like to call the triple whammy: insurance premiums, property taxes, and interest rates. Now, you've heard enough about interest rates from everybody else in today's presentation, so I won't touch on that. And Reggie gave some examples of insurance premiums and property taxes increasing on a local level, which pretty well mirrors what we're seeing nationally too. But the one thing I want to highlight on this slide is how it uniquely affects multifamily as opposed to other commercial real estate assets. For other commercial real estate assets, think retail, office, and industrial investment properties, these expenses are passed through to tenants through triple nets. So they're not directly affecting the operating income for that investor. Whereas in multifamily, these operating expenses are passed through directly to the bottom line, therefore affecting the valuation of those assets. Let's shift over to multifamily development. Now, this chart you're looking at here shows total units under construction in that gold bar and total units that are being delivered or have been delivered in that black bar, dating all the way back to 2000. Now, from 2020 through 2023, we saw over 1 million new units delivered into the national market, which represents a 14.6% increase in inventory since 2019. Now turn your focus to those two bars in 2022 and 2023, the big gold bars there. That shows the total units that are under construction during that time frame. As you can see, we haven't even seen the full effects of these units being delivered into our market yet. Watch for 2024 and 2025 to be record years for multifamily units being delivered into the national market. This is going to have an upward effect on the vacancy rate. So why multifamily? If interest rates are high, if cap rates are compressed, if insurance premiums and property taxes are going up, why are developers still delivering multifamily units? Well, this chart here shows a good representation of the difference between homeownership and renting when it comes to cost. Now, I want you to focus on that bottom bar there. That is showing the total change since the first quarter in 2020 until the third quarter in 2023. Now, in that time frame, we've seen residential mortgage rates increase 3.8%. The median priced home has gone up $109,000, and someone putting 20% down on a 30-year mortgage on the median priced home is paying just over $1,100 more per month in a monthly principal and interest payment. That represents an 111% increase from Q1 of 2020. That's not even including escrow payments for property taxes and insurance. So when you compare that to the 26.8% increase we've seen in multifamily rents nationally, it makes sense why people are gravitating over to renting versus owning. It's simply a lot of people are priced out of home ownership. And as long as we have this gap, developers are going to continue to feed that demand. Let's look at the local market here in Sioux Falls. Let's start by taking a look at the total amount of multifamily units permitted. Now, everyone knows 2022 was a banner year for multifamily units permitted in Sioux Falls. We saw just over 3,300 units. Now, we had a 42% fall off in 2023, down to 1,930 units, which is still the second strongest year on record. I do want to point out, though, I do believe this is a little bit of a false front, as a lot of the units that were permitted last year were second and third phases from developers who had already locked in low interest rates in 2021 and 2022 and are moving forward with their projects. Interest rates are really killing multifamily development right now. I'll touch on this a little more in my predictions. Let's shift over to the total amount of residential permits. Now this is taking the multifamily units we were just looking at. Now we're adding in single family and townhomes to give the true representation of what the residential dwelling units are each year. So if you look at this graph and you say, man, it looks like we're very heavily weighted towards multifamily. Well, we are. As of recently, actually, in 2023, 72% of residential permits were for multifamily. Down a little bit from what it was in 2022, where we saw 78% of residential units that were permitted being multifamily. So how does this compare to what we've seen historically? Well, from 2000 through 2021, only 44% of residential permits were for multifamily. That's a pretty massive shift. Now, this goes back to what we were talking about earlier. The cost of home ownership has gotten so expensive, people are staying, renting, and even gravitating towards renting. So as long as we continue to have this, developers are going to try to find ways to continue to deliver multifamily units. So with all this new multifamily development, how is this affecting the vacancy rate here in Sioux Falls? Well, if you look from about July of 2021 through July of 2023, Sioux Falls had a sub 4% vacancy rate. There was a lot of demand for multifamily. Now, we saw our first crack in the armor this past July when the South Dakota Multi-Housing Association reported a 5.25% vacancy rate. And that continued to tick upwards the remainder of the year, with the most recent number coming in at 5.87% this past January. Now, this is still historically really healthy, and we're still performing better than the national market. But one thing to keep in mind is as vacancy rates continue to climb, property managers get more aggressive when it comes to filling their units. We will see rent growth start to stagnate, in some cases pull back, and we'll see rent incentives offered to try to fill vacant units. Staying occupied is key. So let's take a look at rent growth. This chart shows the average monthly rent for 2-bed and 3-bed units in Sioux Falls dating back to January of 2020. Now I want you to focus in on that same period of low vacancy we were just talking about, July of 2021 through July of 2023. That's that time where Sioux Falls had that low sub 4% vacancy. In some cases, it was sub 3%. We saw a 44% increase in monthly 2-bedroom rent during that period of time. We saw a 54% monthly rent increase in 3-bedroom rent. Now, as vacancy rate has slowly started to climb the last 6 months, we've seen that rent growth start to stagnate. And I do think going into 24, and I'll touch on this a little more in my predictions, but I think we're going to have rental growth stagnation. Let's look at sales volume for multifamily in Sioux Falls. In 2023, we had 28 sales transactions for right around $92 million in total sales volume. Now, this was down about 40% from where we were in 2022. This should come as no surprise, as we're no different than the national market when it comes to dealing with high interest rates and seller expectations on valuation. But deals still got done. We still have investors here that found creative ways to work through deals. Let's take a look at a few of those. This is Three Falls Apartments. This is located on the northeast end of Sioux Falls by Washington High School. This was purchased by an out-of-state investor for right around $71,000 per unit this past February. That's a good buy. Judy Estates. This is located on the southeast side of Sioux Falls. This was sold for right around $156,000 per unit this past January. That's a pretty high number. This was sold for a 5.29% cap rate. So let's look at the cap rate spread like we talked about earlier. In January when this asset traded, the 10-year treasury was floating right around 3.5%, making this a roughly 180 basis point cap rate spread. Pretty tight deal. Viking Villas, this is located on the west side of Sioux Falls, right off Marion. This went for $100,000 a unit this past April. It's a pretty strong comp for a 1978 built product, but in this unique situation, the buyer was in a 1031 exchange and was willing to pay a little premium on this asset to avoid paying some capital gains tax and some depreciation recapture. Six Flats, formerly known as 229 Crossing, this sold this past June for under $57,000 per unit. This is a great buy. There's a lot of room in this property for the buyers to invest capital into this asset, improve the rents, normalize the expenses, and either have a nice long-term hold or to be able to flip this property to another investor upon stabilization. Whisper Ridge Commons. This is located on the southeast side of Sioux Falls, right off 69th and Sycamore. This is actually the second time this asset's traded hands in the last 2 years. This went for about $150,000 per unit, purchased by an out-of-state investor at a 4.88% cap rate. What was the 10-year treasury at that point in time? 4%. This is an 88 basis point cap rate spread here. This is a very tight deal. Parkview Apartments, located in central Sioux Falls, right across the street from Sherman Park and the zoo. This investor bought this for right around $62,000 a unit. This is a great buy. This property will have plenty of upside in the years to come as this property gets improved, rents get stabilized, and the operations get stabilized as well. So predictions for 2024. I think stabilized cap rates will increase by 50 to 75%. Now, I want to highlight the word stabilized. This is referring to properties that have market rents in place and normalized operations. This is not referring to value-add properties as a few of the ones we just looked at on those sales transactions, where investors are valuing those more so on a price per unit base and factoring in how much they need to put into those properties to improve them. I think multifamily sales will remain steady with where we were in 2023. Now, I can see somewhere around 25 to 30 sales transactions, but no, that number can be pushed much higher if the Fed drops interest rates, but I'm with Nick. I'm not holding my breath this year, but Sioux Falls is still a very healthy market. We still have a lot of investors looking to deploy capital into our multifamily market here. So look for creative financing to be done, contract for deeds, seller financing, loan assumptions, or just good value add acquisitions. I think there's going to be less than 1,200 units permitted for multifamily in Sioux Falls in 2024. Now we're going to continue to see second and third phases for developments that are already in the ground, and we still have a couple aggressive developers in our market that are going to continue to push forward. But the reality is, unless you own a construction company, it just doesn't pencil for new multifamily development right now. Like Nick said, at the end of the day, it's just a math equation. Then again, not everybody got an A in math class. I think vacancy rates are going to increase in 2024. Now, this is not sounding the alarm. I don't think we're going to see double-digit vacancy rates in our market anytime soon, but we have a lot of new units to absorb. And it's only natural to think that's going to drive our vacancy rate upwards. So this time next year, I wouldn't be surprised if we're sitting around a 7 to 8% vacancy rate. So where does that put us in the real estate cycle? Well, with increasing vacancy rates, moderate to high new construction, and low rental rate growth, I have Sioux Falls ending 2023 and starting 2024 right at the top of hyper supply. And with that, that concludes my presentation on the multifamily market. I'd like to invite Reggie up here to close us out. Thank you.
Well, as promised, we'd have you out of here by 5 o'clock, and it's 5 o'clock somewhere, right behind those curtains in just 1 minute. I have one closing thought. As we did a deep dive here, there's one word that kept coming back to me, and that word was thankful. I'm thankful I live in this city. I'm thankful I live in this state. I'm thankful for the legend over there, Michael Bender. As the video stated, 6 people were at the first Market Outlook 27 years ago. We're all sitting here and standing here today because of him. So thank you. Also, yeah. We're also thankful for all of you being here today. And this is a thank you gift. This is a Bluetooth speaker and charging station for you so you can listen to Taylor Swift whenever you want to. It's time for happy hour. Come on up. We'll see ya. Thank you.